Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, March 7th, 2023, and let's get right to it because there's a lot of economic data and a lot of headlines moving markets today. So up bright and early, Federal Reserve Chairman Jerome Powell is on Capitol Hill in Washington, basically doing a progress report on ultimately the Q&A on how he's doing. We'll talk about that. But it's ultimately moving the markets. In addition to that, we have jobs report week. This is a very impactful week as it relates to the markets. A lot more volatility. And then we're going to talk about defining volatility as it relates to client portfolios, how we manage, and what a diversified approach looks like over the last 20 years, if you will. So our next, ultimately, let's talk about the Fed's tailored approach. And that's really the headline that Jerome Powell talked about, which is it's different this time. He said that in so many different words, but he also said that he's going to be very, very sensitive as it relates to the economy and his dual mandate. Dual mandate for the Federal Reserve, if you remember, is full employment, but also price stability. Well, we have full employment, the best we've seen in 30 plus, or actually 40 plus years. The price stability, we see a divergence in the economy. Inflation is hot. We saw that last week and all the economic data that's coming out. There's some parts of the economy that are cooling off in terms of inflationary pressures built in, but there's some parts of the economy that are accelerating, i.e. jobs. So that's that tension that we're going to talk about. He basically said they're strongly committed to tailoring the capital rules or their approach, and over time, they believe they can achieve the 2% inflation essentially mark. Now, we're right well above that. We're at the sixes, and the terminal rate for the Federal Reserve is in the fives, and it's pushing higher, which means the Fed funds rate. And we have a inflation rate here, Fed funds rate here. That needs to invert or reverse and then bring down inflation down from a 6 handle to a 2% handle, but they're going to be committed to over time. It's not going to happen this year. It's going to happen over a couple of years, and that's really the course that they're on. It's a different market and economic conditions cycle, he said this time, which is it's different this time. And nothing in the data suggests that they have tightened too much. Now, keep in mind, there's lag effect. So all of the cumulative effect slows the economy down by, higher interest rates on credit cards or higher interest rates on auto loans or higher interest rates on mortgages. This should be a cumulative effect on the consumer, slowing down the economy, and ultimately putting pressure on corporations' balance sheets, right? The top line and the bottom line. The bottom line is to preserve the margin for shareholders. So what are they going to do? It's the wages inside, so you're seeing more and more layoffs. So corporations preserve the bottom line, and ultimately, that's really what's going to be playing out here. They say they have the tools to get inflation down over time, which they do, but this, I believe, is the biggest quote of the day, and it's monetary policy tools are very powerful, yet blunt. And I think that is going to be all eyes on that because we believe, historically speaking, the Fed tightens until they over-tighten and they break something in the economy. Then all of a sudden, it's not hey, let's cruise along in this altitude. Let's now prepare for emergency landing. So I think that's sort of what the concern would be. Equity markets are selling off as a result of that. And if you look at the Fed funds futures, there's now a pricing in of a 50 basis point increase later this month. So the S&P 500, again, I talked about this last week. This is a key critical level of 39.39, 39.40. We touched it, we closed above it, and then we bounced since. We're about the 4,000 level as I'm recording this today. So this is the key level, regardless of sort of how this all plays out, because we're going to be looking at this week. Wednesday is jobs week, as I said. JOLTS, it's the job openings. Remember, we have 2 job openings for every one person looking actively for employment, and that's the tension in labor markets. Initial claims, less people are in the last couple of reporting cycles looking for employment or unemployment benefit claims. So that's sort of a healthy economy still. And then Friday is the big jobs number. It's the non-farms payrolls and the employment rate, the unemployment rate. And so if that still stays around the 3.4% without going up, if it goes up, meaning if unemployment ticks up, that means that the Federal Reserve is doing their job and it's actually working. The policy is actually working. That's why we're paying attention to labor markets, as I described earlier in the video. That's where the tension is for inflation long term. And finally, for clients and the diversification, this is a great chart that basically looks at the last 20 years going back to 1999 of the S&P 500. And ultimately what you're seeing is each bar for each calendar year. Here's 1999, 2001, 2, 3, and so on to 2022. Let's look at 2022. The high side in the intercalendar year was markets were up 17.7%. But we know we closed close to the bottom of 24% on the downside. S&P was down about 20% as we closed 2022. What you're seeing in each calendar year, sort of the volatility, or how high markets go and how low markets go in any calendar year throughout the year. So clearly, we're seeing and accustomed to volatility over the past 20 plus years. This could go back for the history of the markets, but this is just a sample set of the S&P. Now, what's interesting is that the average of the decline intra-year over the last 20 years, if you've been invested, like our clients have been with Blanke Schein Wealth Management over the last couple of decades, you've seen on average a decline in the intra-year, so through that calendar year, of 15, I'll put this right here, 15.9%. Okay, so that means that the market goes down on average over that period of time. Usually it's a 5%, a 10% in a healthy economy. Those are natural, those are market clearing. Those happen all the time. You should probably get 2 5s, drawdowns, and a 10% in a normal calendar year. If it's higher volatility, or sort of 2008, 2009, when we saw the great economic crisis, we saw markets go down 47% here. So all in all, averaging in, you're looking at a 15% decline. So that ultimately means, hey, listen, a diversified portfolio gets us through it, weathers the storms, balance, and the diversification is your friend. And it also helps you by winning by not losing it. It sort of buffers the downside because you don't want to be all equities, you don't want to be all bonds. As we saw last year, both of those are not correlated. They were positively correlated, so both of them actually went down at the same time. So you sort of add in alternative investments as we do, and cash. Again, treasuries, treasury market is screaming higher again, over 5% on the short term, even 4% on the 10-year right now. So right now, while we wait and we prepare for future volatility, as we're seeing like for today, we're putting cash to work. We're getting a lot of bank deposits just for our treasury market. The treasury market, again, is well over 5% on the short term. So as we say, we want to get paid while we wait, and we let the markets come to us, and we constantly dollar cost average into higher quality companies that we know have strong balance sheets and will continue to thrive on the other side, whether it's a bear market or an economic downturn. What happens ultimately, we know that those large companies really get bigger and stronger on the other end. So we want to share accumulate when the market is down. We want to start building positions in new companies that we like, hey, listen, we couldn't get it last time because markets were too high. We didn't like that entry point on that particular stock or that particular ETF or that, let's say, mutual fund, if you will. Now we take advantage of it and we let markets come to us. We hide out in the treasury market and we go from there. So that's our update for today. Again, Federal Reserve Jerome Powell is moving markets, and interest rates are on the rise as a result, as well as the US dollar. So we're watching that trade. So that's our update. Thanks for watching. And again, like, subscribe, share to friends and family, and we'll see you again next time.